Curious how the Fed actually works and what the Fed funds rate means for your money? We break it down in this episode of the Unleashed podcast from Horizon Advisors.
Yeah, I mean, it goes back, through a lot of history, and it's one of those, tools that the government has if they want to cool off, the economy or heat the economy up. Clearly higher rates will kind of cool things down. Lower rates, normally typically heat things up because money is cheap.
Looking back to the decades in the past, that's a big one. The 80s is a big one that a lot of people, if they were around and buying houses or doing whatever at that time, they go back to that time because they say, oh, I remember when I bought my first house, I had a 15% mortgage or 16 or 13 or wherever in the double digits, right? Big numbers. That was a time of very high interest rates.
There was some runaway inflation during that time. Yeah. It was, I wouldn't say the situation's like it is today, but, they had very, very high inflation. That's why they had to kind of keep bringing that rate up.
Yeah, and there was a lot of reasons for that and a lot of reasons why some of these other rates were lower at certain decades and things of that nature. But, it was temporary in terms of the long term, right? Just like any environment, good market, bad market, high rates, low rates, and high inflation, low inflation, all these different things. But that was kind of an outlier decade was the 80s. And then, as the 90s went on, it came back down, averaged around 5.1%. Then you get to the 2000s, and this is where, it starts to get really interesting because that's more of the shorter term in terms of people's memory, in terms of what they remember rates being at. And that's where in the 2000s, you were looking at average around 2.5, the 2010s, which was, basically the aftermath of the financial crisis in 08. You were looking at almost zero, 0.6%, again, virtually zero rates. And then in the 2020s so far, in the shortest near term, we're looking at roughly 3.9, which is also reflecting, the rapid increase, one of the largest increases we've seen in a short span of time. Definitely not the largest ever, of course, going back to what we just stated on the 80s and the 70s, etc. But it was one of the fastest hikes in that period of time, and 3.9% is a number in the 2020s so far, with that being reflected of that rapid hike in 2022. So even if you're getting a 4.5-5% yield on a money market during that time, you're still getting eaten away by inflation,
especially after tax.
And look at it today, if inflation is around 2.7, 2.8, roughly around that mark where we're talking about today, if you're getting 3.5%, again, that's still, solid for liquid money, but you have to remember that inflation's eating away at some of that too. So that poses the question of, when you're looking at the long term, the equity markets is really the place where you are trying to outpace inflation. Bonds and conservative cash, those sort of things, again, you need to have those, you need to have diversification, and they serve their purpose for a lot of different reasons in a financial plan. But, sometimes you have to, again, look at the environment and see, okay, am I actually really making money on this money? If inflation's high and you're not even getting the inflation, well, that is eating away at some of that too. So it's a unique way to look at it.
Tune in to the Unleashed podcast by Horizon Advisors on our YouTube channel for the full episode and get the clarity you need on interest rates, inflation, and the markets.